What's going on, everybody? Peter Toering here.
And Chris Vanbelle.
This is the Homes Great Lakes Real Estate Podcast, talking about all sorts of real estate issues here in Southeast Michigan. We have with us the fantastic Dawn Symington, who is an excellent lender. Dawn, thanks for being with us.
Absolutely. Thanks for having me.
And Dawn is with Mortgage One over in Shelby Township. I guess it's Shelby Township, right?
That's right. Hayes and 59.
Yeah. And so what we wanted to talk about today, we wanted to go into kind of the economic climate and how that affects mortgages. We want to talk about how this is going to affect you as a potential buyer, and kind of assuage some of the fears of, are we going to have 2008
Going
again?
deep today, huh?
Yeah. So the first thing, let's talk about what caused 2008. Let's talk about the mortgage crisis. What was the kind of the environment leading up to this?
Well, goodness, I think a lot of us know it, right? There is a loss of jobs. We know that from our family members losing jobs. At one point, Peter, there were 5,000 people a day moving out of the state of Michigan.
Yikes.
Looking for jobs elsewhere. The mortgage side of things, what was happening was we were securitizing our mortgage or bundling them together and then reselling them on the stock market floor. What was happening was we kept bundling these mortgages together and we put in some junk loans with these AAA rated paper. So a AAA rated paper, somebody with a 740, 760 plus credit score, 20% down payment, and these babies never default. I mean, they never default. There's something, you want your investments in AAA rated paper. So other countries would buy them up. Abu Dhabi had millions and trillions of dollars of mortgage-backed securities in the U.S. and other countries as well. Well, these mortgages started defaulting. And these investors were like, what is going on in the United States? Why is this happening? It was unbelievable. Well, years later, investigations found that they were putting in a little bit at a time. Fannie Mae, Freddie Mac were putting in these BC papers, 600, 580 credit scores, 620 credit scores, these mortgages that were subprime in this AAA rated paper and just kind of hiding them in there.
And you mentioned before the show here that these BC loans, they were having like a 1 in 8 default rate or something like that?
Yeah, so
it's a massive default rate.
Yeah.
That's ridiculous.
Very interesting in that credit scoring is what is a probability of default. So what is the statistical probability that I'm going to default on my loan? And if you have a 580 credit score, you have a 1 in 8 probability of default. 1 in 8. So for every 8 loans that I write with a 580 score, 1 is going to default. Versus if your score is 801, there's a 1 in 1,292 probability that your loan's going to default.
So essentially they were packing in fantastic loans with garbage loans and selling them off to investors. And of course we had, like you said, the auto market, the auto industry collapse, the loss of jobs.
And subprimes. Don't forget about the subprime mortgages. How about those?
Yeah, how the subprime loans affect that as well?
Yeah, subprime is really interesting because at one point, Peter and Chris, we were writing loans with a person that would foreclose on a property or bankrupt. I'll give you an example of bankruptcy. Person bankrupts, they report Chapter 7, they go to court after their bankruptcy is discharged. The next day, with a 580 credit score, they could buy a home with 0 down.
So people that had no business buying homes are being
Good night.
Right.
So, of course, also that and the housing market just being at an absolute peak and just then the bottom falling out.
Well, things were getting crazy even over here. I mean, you had people doing like the refi, and they were getting crazy refis. You'd have $180,000 homes. You know, they'd appraise for like $300,000.
So before we now go through into the what got us to where we are now, and some of the restrictions and everything. How does the lending climate compare now? Because I know that we are lending down to 580. We have a lot of these low down payment options for first time home buyers. I know that there's another Michigan savings plan that was just approved by the House. So there's a lot of different things going on for first time home buyers that are either low down payment or low credit score. How does that climate, compare to what we had pre-crash?
Okay. If you don't mind, I like to just give you a feel for what happened during crash and what the mortgage environment was like after the 580 scores with 0 down. So when the mortgage meltdown happened, everyone pulled back all their lending. BC loans were completely washed up. And so what was left was a lot of government loans, FHA, your VA, your rural development, and conventional paper. So on the so FHA continued to loan at 3.5% down payment, but they would not lend to anyone if you had under a 640 credit score. Then number 2, conventional financing. What's interesting is an appraiser has to mark on his report whether the house is declining, the market's declining in value, stable in value, or appreciating in value. And so in the market meltdown, appraisers notated that it was a declining market trend. So the fear was you'd buy your home at $180,000 and then 2 months later it might be worth $170,000. That was the fear. So Fannie Mae didn't want to be on the hook for that. So instead of allowing you to put 5% down, you had to put minimally of 10% down. So we're at 2010, 2011, 2012, and you have to put a down payment of 10% down.
So we're excluding a lot of home buyers, especially a lot of first-time buyers, people that are now renting instead of buying homes.
Yep.
Yeah, and pummeled. PMI insurance, you just got hammered if your score is under 700, conventional financing.
So moving from that, what do you think pulled us out of this? You know, obviously we're in a fantastic market era. Now we've got low interest rates. We've got all these programs. Was it the implementation of some of these government programs, Dodd-Frank, TRID, some of the other things that were really tightened the belt on the lending? Was it the economic climate? Is it kind of a mixture of everything?
One of the frustrating things that the government did, which actually I think helped us a lot, was develop what's called HVCC, Home Value Code of Conduct, where they pulled back the reins on appraising, and they said, okay, if you're going to do an appraisal, they have to be selected from a random pool of appraisers. They have to be licensed, insured, carry E&O insurance, and you cannot select either as the borrower or as the lender who the appraiser is going to be. So it has to be an unbiased, randomly selected appraisal report. That really did help quite a bit. It built confidence. I think for a while these appraisers were appraising very, very conservatively, almost too conservatively.
Right.
Would you agree with that?
I think that's still going on now.
Oh, big time.
We can talk about in a minute how I think that's partially a good thing. Mm-hmm. But see, now, do you think that it's become a detriment because this random appraiser? If we can talk about this for a minute,
sure.
When you have specialty properties, when you have rural properties, waterfronts, things like that, having a randomly selected appraiser, when there's really no standard for, yes, I know there's a standard of you get X amount for X amount of waterfront frontage. But we all know not all waterfront properties are created equal. Not all rural properties are created equal.
Yeah.
How does that frame out with the random appraisers?
Yeah, that's a great question. So let me give you an example of something that happened about this summer. It was late this summer. So I had a client that was selling a home on Lake Fenton. So they were selling their house, and there was no comparables on Lake Fenton. So I had the buyer had come to me, was pre-approved with me, and they bought this client's house. And so I went to the underwriter and I said, there's no comparables on Lake Fenton. What can be done? And they said, you can go outside of the market area. You can even go to a county next door. You can even go to a town surrounding, as long as it's lakefront to lakefront, and it's a similar market area. So I took that information and put that in the notes for the appraiser. And the appraiser was able to go across county lines, across city, but across the towns without that information being provided. Because they were coming back with no comps.
Right. So they've changed the guidelines a little bit to adjust for some of these specialties.
Look at the lakeshore we have over by us and how it can differ from Algonac all the way to the Points.
Yeah,
it's insane.
Different.
And I've seen appraisers use.
Well, it's different from community to community. It's
in
different
Lottie
in Lottie View.
Lottie View. I've had somebody try to use the shores to compare Lottie View homes, and it's just
wow.
That's insane.
Wow.
But so in this too, we have had, like I said, significant government restrictions. But and have these things been overall Dodd-Frank, TRID? I know that they make your life significantly more difficult. Number one, do they have an impact on your average buyer? And number two, is it helping us or hurting us? Is it bringing us closer to or farther from another 2008 like scenario?
Well, TRID is another interesting. Most don't understand what that means or what that is, but what it does is it has the mortgage. It provides some sort of accountability for yourself as a mortgage lender, as a mortgage banker, in which you need to disclose a beginning of a closing disclosure, a minimum of 4 days before closing. The problem is, whenever there's opportunity, and we're in, and we're our mental minds and who we are as human beings in the United States and being entrepreneurs, everyone will always do a workaround.
Right.
So
yeah,
it's like phenomenal. So if I'm told that my closing costs have to be accurate, but yet I can be disaccurate on homeowners insurance, taxes, condo association dues, real estate compliance fees, tax prorations, I don't even have to mention. That's 5 opportunities that I can understate those things and not have an accountability, not have accountability measures in place. And so I can be accurate on my closing costs, but if I'm off on these 5 things, your client could end up needing to bring $3,000 to $4,000 more to the closing table than they originally expected.
So it's creating an atmosphere where, yes, the clients do, the buyers, because TRID was, for those who don't know, TRID was created essentially so that you're not signing you're not seeing your amortization schedule for the first time at the closing table. You're not seeing your interest rate, your final interest rate for the first time at the closing table, right? This was to protect against that. So now instead, it's creating, yes, you will see this previously, but you may not get accurate numbers of what you actually have to bring to the closing table on time.
Right.
But that depends on having a great lender or not. We've seen some of the lenders try to push these things through, and they're like Dawn saying, way off on insurance or way off on the areas where they can be off.
Right.
As long as they're within their margins on your lender stuff.
That's a great point, Chris. Like, think about this: if you're closing, if your contract says you're closing on the 5th of January, and the lender just takes 1 day of interest, well, that they're saying that you guys are closing on the 30th, but they don't have any responsibility to disclose that properly. They're just trying to compete for the business against someone else that might be fully disclosing everything appropriately. Right.
So it's just another point of make sure that you're going through a good local lender. This is why we discourage the use of the big banks. We discourage the use of, I call them the mortgage mills that we're not going to mention by name. The places that you can tap 3 buttons on your phone and get a mortgage. There's a myriad of reasons not to use those. But
feel free to ask us for stories in person, though.
This is just another reason not to do that. If you call Dawn, she's going to give you an accurate accounting of what you're actually going to be bringing to the closing table. So now here we are in 2017. Mm-hmm. I've been preaching for months that I think that we're at the top of the market. The numbers keep proving me wrong, and the housing market still keeps going up, and the inventory still keeps going down.
This little birdie's been telling you that too.
I love being proven wrong on stuff like this, Chris. I really do. But what we are seeing is, like I said, with FHAs being dropped down again, with the myriad of first-time home buyer programs, with the massive amount of student loans that people are bringing. How do you think that this is going to, where are we going from here in our housing, not only our housing climate, but in the, obviously we have a good economic climate right now, but where do you see loans going? Do you see us going back to these, relaxing these regulations again?
Yeah, I see guidelines loosening up every other month. I'm curious to see what new program is coming out, what reintroduction to a previous program is being reintroduced, government aid money as far as MISHDA is concerned. We can talk more about that. Mm-hmm. And then guidelines changing, going from 10% down on the mortgage meltdown to 5% to 3% down. And then there's being reintroductions of zero down loan programs. And then there's subprime companies coming back on the scene again, which is your loans that are offered 2 and 3 year fixed rates, and then it becomes an adjustable rate after that, and with high adjustment periods and whatnot.
Which, and I saw penalties. That because of the GDP this quarter that we're looking at another interest rate hike increase, correct?
Oh, it's been up and down like crazy lately. If you watch it daily, some days it's up just a tick, some days it goes back down.
Yeah, and so with this, where do we see this going as far as we know that we have, and I know that there's some things keeping us from the brink, and we'll talk about that in a second, but can we expect another round of regulation, belt tightening regulation, so to speak?
No, I don't think so. Okay. I think it's going to go the other way. I think there's less regulations and more loosening of guidelines. Trying to let the economy operate on a more of a free market economy is really something that I think we're going towards more and more.
And I generally like to think, if you guys have listened to me at all, you know that I'm generally against government regulation if at all possible. But is there, and I know we've talked about the possibility of there being another 2008. So if it doesn't come from the regulations that we had in 9, 10, 11, is it going to come from the other factors? And this is where I want to bring up, number one, we've battled appraisers appraisers seem to be keeping us down and keeping us away from hyperinflating prices, and then to the lack of first-time home buyers going beyond what they can afford.
Well, conversely, with the appraisers and our what we consider not a good appraisal, low appraisal, whatever, we're finding more people bringing money to the table because they see the value in that home. And now I've seen $10,000, $20,000 being brought to the table because somebody sees the value in that home, whether the appraiser thinks so or not.
And that's where I think we get into trouble. I think we get into trouble when we start hyperinflating markets, when we start to come in and saying, okay, and also we were talking about this before the show as well. We have two things. We have a dichotomy in our market here in Macomb County, and we have a difference in the way appraisers view properties and the way clients view properties, or buyers view properties.
Yep.
Buyers are increasingly emphasizing updates,
Quality.
Quality.
Right?
Exactly.
Yeah, that's a huge one. They want to see the granite. They want to see the wood floors.
Yeah.
New furnace,
Right.
new roof,
Yeah.
new windows.
But
They
what
want those amenities.
Exactly. But what they don't want is we're not seeing these. They're not coming out and saying, I need a 25, 27, 2,900 square foot house right out of the gate. So what the appraisers are doing is the appraisers are putting a real focus on price per square foot. They want to, have the value of the actual house. And the buyers aren't seeing it that way. Which, on the flip side, where it may cause you a low appraisal in areas like Royal Oak or Ferndale, somewhere else that updates are very important, it's causing higher appraisals than I think market value is on the big houses.
Sure.
So, and this is where we get into, and we've talked about this if you listen to our market reports about the dichotomy between the 250,000 and under and the 300 and above. And I think part of it is because millennials and people my age are going towards
look at how big
areas
of a part of the market
houses.
the millennials are right now.
Mm-hmm.
And their wants and needs are controlling a lot of what's going on.
28% of home buyers or something like that. I'm just pulling that out of my head. I think that's what I read. But they're buying under their means in the vast majority of cases, and they're not buying these huge houses.
A lot of them are coming in conventional.
Yeah. So do you think that this is going to help us stay away from that edge again?
Yeah, I really appreciate the millennials and their education levels and in their choosing to live under their means. I think where they're not realizing is the student loans and how that's going to impact them in the years to come, because they haven't been making payments on student loans and they don't expect to for sometimes up to 2-3 years after the point that they're going to own a home. At the same time, I think it's really going to help that they're very particular on their financing, and they're very smart on their choices for financing under their means.
And now, do you think that if we have a rash of student loan defaults, that will throw us back into and just wreak havoc in the mortgages as well, or do you think that the one can happen without the other?
Yeah, I think the one can happen without the other, mainly because that's a great question, Peter. I don't know. That's a really great question, because what happened when the mortgage meltdown happened? If you couldn't find a job and you were 20, 21, 22 years old, you got your degree as a bachelor, you got your bachelor's degree, and these kids, they could not find jobs. So what did they do? They just hunkered down and went for their masters. Some of them kept going for their doctorates. And so you have an influx of very, very educated individuals coming out of school with very, very, very little, low income, very little jobs, but lots of student loan debt.
Right, which is of course leading to we're at the highest rental rate we've ever been, which I think we're battling against for a lot of reasons.
Peter, the other thing is, it's really interesting to see someone with 100 to 100. It's not outrageous to see. I see a lot, $100,000 to $150,000 in student loan debt. I see that a lot. And then coupled with a mortgage, let's say it's a $180,000 loan, they technically have $300,000 worth of payments, and usually student loans, they want them repaid within 10 years.
Yeah,
that's a hefty payment.
Without a house. You know what? I really want to talk about this about first-time buyers. Dawn, thanks. We're gonna guys stay tuned with us in the next podcast from Dawn here. Thanks so much for being with us,
Cool,
guys. We're gonna see you next time.
Thank you.